it's about risk management. For us, time is risk. When we think about lending into projects, we always have to think about what can go wrong and what are our options available. And we're taking construction risk, market risk. Developers do the same, right? If you think about development risk margin, you can allocate some of that margin to the market. What's your selling risk? How deep is that liquidity pool for buyers? Construction risk, equity risk. And you're pricing sort of those levels, and construction is a key one. You can mitigate what can go wrong in construction, or more importantly, how you can reduce time when things go wrong and avoid these time blows. I think one of the major costs when we see problems in construction is actually the time value of money, the cost of financing costs. Whilst you're waiting to fix all these things, yes, construction costs will go up, but the impact of time is critical. And so the insurance product gives you more options reduces time.
So I'm here with Drew Bowie. Thanks for jumping on camera, mate. Good to see you.
Good to see you, Mike.
So tell me, resilience, latent defects insurance, I think you guys are some of the financiers that are really getting in behind it early on. What's your take on it?
Well, it's about risk management. For us, time is risk. When we think about lending into projects, we always have to think about what can go wrong and what are our options available to us when things go wrong. A bit like paying car insurance. You don't like paying it, but until you need it, and then it's really valuable. Similar with this product, it gives you options when things go wrong.
Yeah, I think in some ways it's kind of a similar perspective probably to the consumer, where they're trying to manage their own risk, but participating in a great project can be a good thing for both the financier and the consumer if you can find effective ways to reduce the risk.
Yeah, well, we at MA Financial, through our consumer mortgage, residential mortgage businesses, we have exposure of about $130 billion throughout Australia, and billions more in our construction financing. And what we're finding is that consumers, and indeed their conveyancers, their advisors, they have a lot of information at their fingertips. They'll Google search every project that they're looking at before they buy, so are their conveyancers. And if they're identifying problems, that's a challenge for vendors.
Yeah, one of the things we notice on Urban is that every time we write an article about a project and it features resilience, we see conversion increase, engagement with that article lift as well. Because I think everyone has a property expert in their family that is kind of advising them to do A or to do B, and at times off the plan hasn't always delivered. But I think when we have products like this that are coming out where the consumer can be protected for a 10-year period, it gives consumer confidence, and clearly it gives the financier confidence as well.
Well, it's pretty much everyone's largest asset.
Yeah.
Right, and it's the creation of wealth that we have through the residential markets, particularly with the tax system the way it is, means that the enduring value of your house, of your apartment, is critical to your financial well-being. So it's really soul-destroying, actually, when you hear of consumers buying in and having all these problems around material defects. If we can eliminate that, then that's a good way to go.
Totally. I mean, part of the reason we are building Urban is to try to improve the quality of off the plan in general. And I think when I first met with Corey, it was one of the first times, I've got to be honest, that I was ever excited about an insurance product. It can be a dry kind of category, but what it actually means for people in terms of if things do go wrong and having that protection, I think it's even almost in some ways like altruistic. The business could be perceived like that, the resilience business, because I think it's doing a real service to the market, and I think it's also obviously giving the banks confidence to provide the lending. Does it change the way you think about lending at all in terms of the consumer or the developer?
It does, absolutely. We're always thinking about what can go wrong. We have to, right? We're pricing for risk, and we're taking construction risk, market risk. Developers do the same, right? If we think about development risk margin, you can allocate some of that margin to the market. What's your selling risk? How deep is that liquidity pool for buyers? Construction risk, equity risk. And you're pricing sort of those levels, and construction is a key one. So if you can mitigate what can go wrong in construction, or more importantly, how you can reduce time when things go wrong and avoid these time blowouts. I think one of the major costs when we see problems in construction is actually the time value of money, the cost of financing costs, whilst you're waiting to fix all these things. Yes, construction costs will go up, but the impact of time is critical. And so the insurance product gives you more more options reduces time, and so that's a critical element.
And so would you, if you had a developer coming to you that, for example, didn't have LDI versus did, how does that kind of change some of the conversations that you're having with them?
It changes pricing.
And that's pretty important, right?
Absolutely. It's not the be-all to end-all. We will still do deals without it, but we encourage to have it. And unless we've been priced down to within an inch of our lives, we'll try and support a contribution towards that additional cost as well, because it reduces our risk. It reduces the risk of time blowout, and so we would encourage it, certainly in New South Wales.
And so you're saying that you guys you would even help finance part of the 1.5, the typical kind of 1.5%?
We actively do.
Yeah, wow. Geez, and so how's that kind of evolved over the last few years? Obviously, it's a relatively new product in Australia. When did you first hear about it, and how have you seen it kind of become more broadly adopted in the marketplace?
So we were, I guess, one of the early adopters of it. I'm not sure how many conversations we had before we had our first conversation around it, but I've been financing projects for over 30 years, and one of the things that we recognise is that builders can go broke in good times too. Builders have challenges in good times too. Obviously, we've seen a huge increase in the amount of builder insolvencies and risks around that particular sector, but as that eases off, as price increases eases off, it doesn't necessarily mean that problems with builders ease off. There will still be problems going forward. So we were very keen to understand if there's new options available to us, that gives us greater flexibility for when things go wrong, greater certainty as to what we're dealing with at the asset level when things go wrong, and ensuring that we're backing projects that have enduring value. That's one of our catch cries within my team, is are we backing assets that have enduring value? So good quality, because those projects will withstand time. We can never predict when the market's going to collapse. Could collapse tomorrow, there could be a big global market event, I don't know. We can't predict it. But what we can determine is when markets eventually recover, the good quality assets will be the first to recover. Poor quality assets will simply become older, poor quality assets. And so that's what we focus on. And so enduring value to us means design, it means quality, it means assurance around defects.
I think at the end of the project, when it's completed, and off the plan really does compete largely with established. I think that's something that a lot of people misunderstand, is that they think they have two projects perhaps in the same suburb, and they think it's really those two going ahead. But when we talk to consumers, it's oftentimes they're trying to decide which one are they going to go for, and perhaps then they decide to go off the plan. I think anything that lifts the overall quality of the value proposition of new property, like a car, people prefer a new car relative to an old one. But I think when it's got this type of warranty that comes with it for a 10-year period, I think it kind of can help increase the intrinsic value of the property and make it a more kind of durable asset like you're describing.
Yes, well, quite simply, you'd rather have a big green sticker on your signboard than not.
Yeah.
Right? So it's very hard to determine how the markets will respond at any given time. But if you've got something that's even slightly better, I think it's a lot better, but even if it was even slightly better, that's putting you at an advantage. That will be more prevalent if markets are quiet and it's harder to convert those purchases. I don't think it's a bad thing. I really can envisage that it will add more to the value of the product than what it's cost in premium.
Yeah, certainly when we've surveyed consumers and asked them if you had project A and project B, how much more would you pay? And it was about 70% of people that said they'd pay more than 1.5%. And there were actually a lot that were kind of more around the 3% mark. So again, for the developer, although there is a cost attached to it, we think that for the most part, it's going to end up being a profit centre through price appreciation.
There will be some people that simply will not buy it without the sticker.
Yeah.
Forget the price differential. If you're being stung, or one of your consultants or one of your family members have been stung on a project with serious defects, they are just not going to go there again, and they're going to tell people about it. And that's one of the wonderful things about the residential market. One of the things we all love about it is that it affects so many people. It's such an interesting topic to so many people. It's a barbecue conversation, right? And so all those messages filter through, and so it's quite possible that you will just have people that will just say, no, I won't do it without it.
So have you got any kind of final thoughts in terms of developers that are perhaps considering taking on resilience? What would you say to them?
investigate. We fund without it and we fund with it. I think it's a sensible thing to do. At least talk to them, understand it, talk to us. We can tell you from our perspective, not just from a consumer, but when I talk about enabling options when things go wrong, we can talk to that and really from a developer's perspective understand how it reduces that risk. And maybe we'll pay for it anyway.
Well, thanks, Drew. I appreciate it, and cheers for coming and sharing your experience.
Pleasure, mate.